Now that you're familiar with what money is, how banks operate, and the Federal Reserve System, we can begin to talk about the concept of monetary policy. By definition, monetary policy is the adjustment of the money supply to change the macroeconomic environment. The Federal Reserve Bank, specifically the board, is responsible for managing the money supply, and they do that using several tools. In the past, they have used open market operations, quantitative easing, adjusting the reserve requirement, and adjusting the discount rate. Let us talk about these tools in more detail. Open market operations is the main tool used by the Federal Reserve. It is the purchase and sale of bonds and treasury bills by the central bank to adjust the money supply. When the Federal Reserve wants to reduce the amount of money in circulation, it sells its inventory of securities, and in doing so, it trades securities for dollars. The public or banks purchase these securities because it provides them with a return that is higher than the return currency provides them. So when the Federal Reserve sells securities, it is in essence purchasing dollars. Selling securities allows the Federal Reserve to pull money out of circulation. On the other hand, if the Federal Reserve wants to increase the money supply in the economy, it approaches banks and the public to purchase their securities. In return, the Federal Reserve is supplying the market with cash, which is then deposited into bank accounts and causes the money supply to grow. Quantitative easing is a similar concept, but rather than buying US securities, the government will specifically purchase assets in certain markets to help target liquidity within that market. For instance, in 2008, when the housing and mortgage markets collapsed, the Federal Reserve specifically bought mortgage-backed securities and other assets that you find in the housing market. And the goal was to provide cash to that segment of the market, which needed liquidity the most. The Fed ended up purchasing $1.25 trillion in mortgage-backed securities in 2008. From the previous discussion about the simple money multiplier, we know that the Federal Reserve can increase or decrease the ability for banks to lend by adjusting the reserve requirement. For instance, if the current reserve requirement is 10%, then banks will be able to generate 1 divided by 0.1 or $10 for every dollar that is deposited. If the Federal Reserve reduces that required reserve ratio to 5%, then the money multiplier will increase to 20. While this tool is available to the Fed, it is rarely used. The discount rate is the rate the Federal Reserve charges banks when they borrow directly from the Fed. Decreasing this rate increases banks' ability to use the Federal Reserve when it needs cash. The most common tools to the Fed are open market operations and targeted liquidity through quantitative easing. Next, we'll look at the process of monetary policy when the economy is not at equilibrium and how monetary policy impacts interest rates and spending in the economy.